Welcome back to Bitcoin Podcast, everyone. I'm Bit.
And I'm Ether. Today, we're diving deep into a term that's become increasingly common in modern finance, Bitcoin. So, Bit, what exactly is Bitcoin?
Great question, Ether. Bitcoin is a pioneering electronic currency, marking the start of a new era in digital money. It was introduced in 2009 by a mysterious individual or group known as Satoshi Nakamoto. The core idea was to create a peer-to-peer transaction system, allowing people to send and receive money directly without needing intermediaries like banks.
So, it's a new kind of money, but also something more?
Precisely. Bitcoin's arrival wasn't just about a new currency, it laid the foundation for the entire cryptocurrency market. Since its inception, Bitcoin has seen tremendous growth in market capitalization. Its popularity and acceptance are growing globally, with many countries and organizations starting to recognize and allow its use as a payment method or an asset. Some even view Bitcoin as a future currency, highlighting its revolutionary potential.
I've heard Bitcoin called many things: digital money, virtual money, electronic money, cryptocurrency. It can be a bit confusing.
It can be. Essentially, cryptocurrency is a form of digital asset that uses encryption technology to secure transactions and control the creation of new units. Virtual money, by definition, is a type of digital currency not managed by any central authority, issued by software developers and often accepted for payment within a specific virtual community. Bitcoin is considered a prime example of a digital electronic currency or cryptocurrency, created and traded entirely online through complex encryption algorithms.
What's the technology that makes Bitcoin possible?
Bitcoin's existence and operation are based on a groundbreaking technology called blockchain. Bitcoin was not only the first cryptocurrency, but also the first successful application of blockchain technology, a revolutionary invention in data storage and transmission.
Can you explain what blockchain is in simple terms?
Think of blockchain as a distributed and decentralized digital ledger designed to record information transparently and immutable. Instead of storing data on a single central server, blockchain distributes information across a vast network of computers known as nodes. Each node in this network holds a complete copy of the entire blockchain, creating a highly secure and reliable system.
So data is stored in blocks, and what does immutable mean in this context?
Exactly. Data on the blockchain is organized into blocks, each containing a set of verified transactions. These blocks are linked together chronologically using cryptography, forming an unbreakable chain. Immutability means that once information is recorded on the blockchain, it cannot be altered or deleted. Any attempt to modify a data block would change its cryptographic code and break the link with subsequent blocks, making the change easily detectable by other nodes in the network. To ensure data integrity, any new information to be added to the blockchain must have the consent of the majority of nodes in the system.
Are there different types of blockchain? And is blockchain itself virtual money?
Good questions. There are various types, including public, private, and permissioned blockchains. Bitcoin operates on a public blockchain, meaning anyone can join the network, view, and verify transactions. And it's crucial to note that blockchain is not virtual money. It's the underlying technology behind many cryptocurrencies, including Bitcoin. This technology has broad potential applications beyond cryptocurrencies in fields like supply chain management, healthcare, finance, and many other industries.
You mentioned Bitcoin is peer-to-peer. How does that fit in?
The peer-to-peer network is another key element. Bitcoin uses this model to allow transactions to occur directly between the sender and receiver without intermediaries. This network consists of a collection of nodes, computers working together to maintain and verify the electronic ledger. In this network, each node acts as both a client and a server, capable of updating, transmitting data, and verifying the validity of transactions. This peer-to-peer nature is a core element of Bitcoin's decentralization.
So, to be crystal clear, Bitcoin is not blockchain, and blockchain is not Bitcoin?
Precisely. Blockchain is the foundational technology, the platform that allows data to be stored and managed securely and transparently. Bitcoin, on the other hand, is one of the first and most famous applications of blockchain technology. While blockchain can be used for many different purposes, Bitcoin is a specific digital currency that uses blockchain to record and secure its transactions.
Let's talk about Bitcoin's origins. How did it all start?
What were some of the early milestones? A crucial milestone was the mining of the first block, known as the Genesis block, on January 3, 2009. This event officially marked the birth of the Bitcoin network. The first Bitcoin transaction took place on January 12, 2009, when Satoshi Nakamoto sent 10 BTC to Hal Finney, a developer and pioneer in the cryptocurrency community. By 2011, Satoshi Nakamoto had gradually withdrawn from the project, leaving its development to the community.
What happened in the years that followed?
In July 2010, the MT-Gox exchange opened, quickly becoming the largest and most famous Bitcoin exchange. Also in 2010, the first real-world commodity purchase with Bitcoin occurred when a programmer named Laszlo Hanyecz spent 10,000 BTC on 2 pizzas. This event has become a famous story, and May 22nd is now celebrated annually as Bitcoin Pizza Day. In 2011, the value of Bitcoin reached $1.
The price didn't stay at $1 for long, did it?
Not at all. 2012 saw the first Bitcoin halving event, a mechanism designed to slow down the creation of new Bitcoin. By 2013, the price of Bitcoin surpassed the $1,000 mark for the first time, attracting significant media and investor attention. However, 2014 witnessed a negative event when the MT-Gox exchange was hacked and declared bankruptcy, causing major concerns about the safety of trading Bitcoin.
What about more recent history?
2017 was a major turning point when the price of Bitcoin peaked at nearly $20,000, creating a frenzy in the cryptocurrency market. After that, the price saw significant correction. By 2021, Bitcoin achieved another important milestone when its market capitalization surpassed $1 trillion. In the same year, El Salvador became the first country in the world to recognize Bitcoin as legal tender. 2024 saw a major step in Bitcoin adoption when the U.S. Securities and Exchange Commission, SEC, officially approved spot Bitcoin ETFs, opening up Bitcoin investment opportunities to more traditional investors. Also in 2024, the MT-Gox exchange began the process of repaying creditors after many years of being hacked.
It's been quite a roller coaster for Bitcoin's value.
Indeed, Bitcoin's value has been on a volatile journey since its inception. Initially, Bitcoin had no exchange value in US dollars. The first recorded exchange rate was in October 2009 when $1 US was equivalent to 1,309.03 BTC. From less than $1 in 2011, Bitcoin's price soared to 1,000 by the end of 2013. In the following years, its value continued to experience many surges and sharp declines. By 2021, Bitcoin's price had surpassed the $60,000 mark. While there are predictions of future price growth, Bitcoin's price can also fall due to various factors, reflecting the risky nature of this market.
So how does Bitcoin actually work on a day-to-day basis?
Bitcoin's operation is based on a complex yet transparent process that allows users to conduct online transactions without the intervention of traditional financial institutions. Each Bitcoin transaction is a transfer of digital value from one Bitcoin address to another. These transactions are initiated by users through their Bitcoin wallet software and then broadcast to the Bitcoin network for verification.
Who does this verification?
The transaction verification process is carried out by a decentralized network of miners. New transactions are gathered in a temporary area called the mempool, where they wait to be selected by miners to be included in a new block on the blockchain. Miners use specialized high-performance computers to solve complex cryptographic puzzles. This process is called Bitcoin mining, and it not only verifies transactions, but is also the mechanism for creating new Bitcoin. The difficulty of these puzzles automatically adjusts based on the number of miners participating in the network, aiming to maintain an average block creation rate of about 10 minutes.
What happens when a miner successfully solves a puzzle?
When a miner successfully solves the puzzle and creates a valid block containing verified transactions, this block is added to the blockchain, becoming a permanent part of Bitcoin's transaction history. To incentivize miners to participate in this process, they receive a reward of newly created Bitcoin and the transaction fees included in the block they verified.
How secure and private are these transactions?
To conduct Bitcoin transactions are encrypted and recorded on the blockchain, making it extremely difficult to counterfeit or alter transaction information. Although all transactions are publicly recorded on the blockchain, the real identity of users is protected through their Bitcoin wallet addresses. Each user can generate countless wallet addresses without worrying about duplication, enhancing the anonymity of transactions. What do users need to actually make a Bitcoin transaction? To conduct Bitcoin transactions, users need a digital wallet to store their private key. A Bitcoin wallet can be an application on a computer or phone, or a dedicated hardware device. Each Bitcoin wallet has a public address, about 27 to 34 characters long, which is used to receive Bitcoin. The private key, similar to a password, allows the user to access and use the Bitcoin associated with that wallet address to make transactions. Protecting the private key is extremely important, as anyone who obtains it can access and use the Bitcoin in the wallet to make transactions. Is there a limit to how many Bitcoins can exist? Yes, that's one of Bitcoin's crucial economic features, its limited supply. The total number of Bitcoins is designed to never exceed 21 million. The mechanism for creating new Bitcoin is controlled through the mining process and the halving event. The halving event occurs approximately every 4 years, when the reward for mining a new Bitcoin block is reduced by half. The purpose of this is to control inflation and ensure that the total supply of Bitcoin will never exceed the set limit. It's predicted that all 21 million Bitcoins will be mined by around the year 2140. What are the main applications and purposes of Bitcoin? Initially, Bitcoin was created to be a decentralized payment method, independent of the control of traditional financial institutions. It allows users to transfer money online directly without intermediaries like banks. Compared to traditional international payment methods, Bitcoin transactions are often faster and have lower costs. Today, an increasing number of merchants and businesses worldwide accept Bitcoin as a payment method for their goods and services. Some countries have even made moves to recognize Bitcoin, with El Salvador being the first to adopt Bitcoin as legal tender. However, the use of Bitcoin as a means of payment has not yet achieved widespread popularity like traditional payment methods. Notably, in Vietnam, current law does not recognize Bitcoin as a legal means of payment. Besides payments, are there other significant uses? Yes, many people also view Bitcoin as a store of value. With its limited supply managed by computer code, some investors believe Bitcoin can be a more stable and secure form of currency than traditional fiat currencies, which are at risk of losing value due to inflation. Compared to traditional assets like gold, Bitcoin has advantages such as being easy to store, having lower storage costs, being divisible into smaller units, Satoshi, and being easily transferable. Due to its scarcity and potential for value appreciation, many people have bought Bitcoin as a speculative investment. However, it's important to note that Bitcoin's value can fluctuate wildly in a short period, posing significant risks to investors, especially those with short-term investment horizons. Any other emerging applications? Beyond these two main uses, Bitcoin has other potential applications. For example, it can be used in margin trading, allowing traders to leverage financial positions to trade with smaller capital. The development of new token standards on the Bitcoin network, such as BRC-20, is expanding the application possibilities of the Bitcoin blockchain, enabling the creation of various digital assets on this platform. Projects like RGB Protocol and Spider Chain are also working to bring smart contract functionality to Bitcoin, opening up new possibilities for decentralized applications on its network. Furthermore, blockchain technology, Bitcoin's foundation, has wide-ranging potential applications in many fields beyond currency, including finance, banking, supply chain management, healthcare, electronic voting, data storage and protection, and many other industries. Bitcoin wallets can also be used as a secure place to store other cryptocurrencies. What would you say are the main advantages and disadvantages of Bitcoin? Bitcoin offers several distinct advantages over traditional financial systems. One of the biggest is its decentralization. Bitcoin is not controlled by any government, central bank, or financial institution, giving users complete control over their assets. Transparency is another key advantage.
All Bitcoin transactions are publicly recorded on the blockchain, creating an auditable accounting ledger accessible to anyone. This helps increase trust and minimize the risk of fraud. And security?
Security is a crucial factor contributing to Bitcoin's appeal. Bitcoin uses advanced encryption technology to protect transactions and prevent fraudulent activities. Transactions are encrypted and nearly impossible to counterfeit. Thanks to its high security, Bitcoin users don't need to adhere to PCI, payment card industry standards, as they do when using credit cards, opening up opportunities to participate in markets with high fraud risks. Bitcoin's resistance to counterfeiting is also a significant advantage.
Those sound like strong positives. What about the downsides?
Alongside its outstanding advantages, Bitcoin also has some notable drawbacks. One of the biggest is its extremely high price volatility. Bitcoin's price can rise or fall sharply in short periods, posing significant risks to investors and those using Bitcoin as a means of payment. This volatility also raises concerns about the potential formation of asset bubbles.
Are there security risks for users?
Security risks are also a major concern for Bitcoin users. Although the Bitcoin network itself is very secure, storing and managing Bitcoin depends on the user. Losing a wallet password or being hacked can lead to the loss of all owned Bitcoin. Therefore, users need to have knowledge and implement strict security measures to protect their assets.
And legal issues?
Legal issues are another significant drawback of Bitcoin. Currently, many countries still lack clear legal frameworks or have restrictive regulations regarding the use and trading of Bitcoin. In Vietnam, using Bitcoin as a means of payment is illegal and not protected by law. Owning, buying, selling, and using Bitcoin carry many legal risks for citizens. There are also concerns that Bitcoin could be used for illegal activities such as financing terrorism. Finally, due to its volatile nature and lack of backing by any organization, investors in Bitcoin risk losing all their invested money.
How does Bitcoin fit into the global financial system, especially from a legal perspective?
Legal perspectives and regulations related to Bitcoin vary significantly across the globe. Most countries currently do not accept Bitcoin as a legal means of payment. Many nations have issued warnings about the risks for Bitcoin users, emphasizing price volatility and other potential dangers. In Vietnam, the State Bank of Vietnam has clearly affirmed that Bitcoin is not currency and not a legal means of payment under current law. Credit institutions in Vietnam are not allowed to use Bitcoin as a type of currency or means of payment when providing services to customers. Owning, buying, selling, and using Bitcoin are considered activities with many potential risks and are not protected by Vietnamese law. Similarly, many other countries like Thailand, Russia, France, China, Malaysia, Indonesia, and Norway do not recognize Bitcoin as a legal currency.
Are there any countries that are more open to it?
Yes, some countries have a more open stance. El Salvador took a historic step by becoming the first country in the world to recognize Bitcoin as legal tender. The issue of Bitcoin taxation is also an important legal aspect, and tax regulations for Bitcoin vary by country. In Vietnam, due to the lack of a comprehensive legal framework, Bitcoin transactions are currently not taxed, but in many developed countries, profits from Bitcoin investment can be taxed like other capital assets.
What's Bitcoin's potential impact on the traditional financial system?
Bitcoin, with its decentralized characteristics and ability for transactions without intermediaries, is considered a technological revolution with the potential to significantly impact the traditional financial system. Bitcoin's original goal was to eliminate the need for intermediaries like banks in financial transactions. Blockchain technology, Bitcoin's foundation, is increasingly being applied in many areas of finance and banking, bringing greater efficiency and transparency. Some believe Bitcoin has the potential to become an alternative to traditional fiat currencies. However, high price volatility and legal issues remain significant obstacles to Bitcoin completely replacing the current financial system. Nevertheless, the potential of blockchain technology to improve the efficiency and security of financial transactions is undeniable.
To wrap things up, what's the overall importance and future of Bitcoin?
In summary, Bitcoin is a pioneering and the largest decentralized electronic currency built on blockchain technology. It operates on a peer-to-peer network, allowing direct transactions between users without intermediaries. Bitcoin's history is filled with important milestones, from the mysterious emergence of Satoshi Nakamoto to value fluctuations and increasing global acceptance. Bitcoin operates through a process involving transactions verified by miners, mining to create new Bitcoin, and the use of public and private keys to secure ownership. Its limited supply and the halving event are important economic factors affecting Bitcoin's value.
And its primary uses and challenges.
What does the future hold? In the future, development and innovation in the Bitcoin ecosystem, such as new token standards and efforts to integrate smart contracts, could open up new applications and enhance its usability. Broader acceptance may come when legal regulations become clearer and more favorable. However, Bitcoin also faces challenges such as network scalability, the high energy consumption of the mining process, and competition from other cryptocurrencies. The long-term role of Bitcoin in the global financial system remains an open question, but its importance as one of the groundbreaking inventions of the digital age is undeniable.
Thank you, Bait, for that comprehensive explanation of Bitcoin. It's certainly a complex but fascinating subject.
My pleasure, Ether, and thanks to our listeners for tuning in to Bitcoin Podcast.